EM sell-off, political unrest and mounting fears of a slowdown in China. Can any of this put the Fed off the taper track? I'm Monica Gibson and I'm joined down the line by Peter Kinsella for the week ahead. Peter, risk aversion triggered by worries about China credit risk, EM currency pressure and some US earnings disappointment weighed on global equity markets at the end of last week. But how would you describe sentiment at present?
Sentiment remains poor. You can see the safe havens are in demand, especially Swiss franc and some others. If you look at emerging market currencies, they've strengthened just a little bit over the course of the morning, but this is mainly in relation to the actions that are supposedly going to be taken by the Turkish Central Bank tomorrow night.
Arguably, the FOMC will be front and centre this week. Many analysts expect the Fed to announce a further taper of $10 billion, but again accompanied by dovish forward guidance. Therefore, analysts are not thinking that the equity market correction, which is currently underway, will influence their decision. Do you agree?
I think that should be broadly on course. I mean, most of the data coming from, the hard data, not necessarily earnings data, has been pretty good. You've seen the unemployment data have continued to decline. So all told, that should really underpin this move towards tapering by the Fed. They're still going at what is a very modest pace, in my opinion, and a further 10 billion is frankly speaking, is neither here nor there in the greater scheme of things. That being the case, I don't really think that the equity market corrections you've seen in the last week or so will really influence our thinking in that big a regard. Remember, equities can go higher, they can go lower, within any space of time, and really the central bank has to look beyond that and look through that. So I'm very much of the view that the Fed will go by another 10 billion this week.
Last year's taper correction was 7.5%. So according to some analysts, there is scope for corrective activity to continue this week. What are the risks of contagion in this instance though? Is this just a correction or actually a pullout in your mind?
I think there's 2 points really. Certainly if you look at emerging markets, there's a couple of things to look at. First of all, of course, there's always going to be some vulnerability, particularly amongst higher yielding currencies, when your major currencies start to appreciate and you start to see developed market yields trade a little bit higher. So that was to be expected. However, at the same time, you do have within many emerging markets a pretty severe problem with their current account financing. And that's clearly going to be a bit of a burden on these currencies and indeed on many emerging markets for quite some time. So to call it a correction is probably an understatement. Rather, we should really call this a period of adjustment where emerging markets in general are adjusting to a slower growth background. They're adjusting to slightly weaker commodity export prices, and they're also adjusting to let's say higher cost of funding in general. So all told, this is much more of a period of, let's say, structural adjustment rather than a mere correction.
We have UK GDP, US housing and Japanese unemployment to be released, all with the potential to move these major currencies. Safe havens seemed popular in early trade, with demand for the franc and the yen intensifying. But what is your outlook for the US dollar against the yen with the backdrop of this EM sell-off and FOMC taper decision?
The main thing to look at probably is UK GDP data, which are going to come out. These are trading, let's say, UK data have been, definitely coming out quite strongly in the last 6 months or so, and I fully expect this to continue. So that being the case, I would expect the pound to appreciate somewhat in the coming days, weeks, and months. With respect to dollar yen, you've seen that cross yen traded a little bit more on the low side of things, pretty much in line with slight increases in risk aversion. So I would expect that, let's say, to continue a little bit. I don't think the case for massive yen outperformance is necessarily in track as yet. But that being the case, probably engaging in slightly riskier crosses at this point in time is probably a little bit premature.
Peter, thank you so much for your time and insights today. Lovely to speak to you as usual. Viewers, the TV team has a whole host of programmes to bring you today, including press review and forecasts, so please do keep clicking back to the website. Goodbye for now.